What is good, Snatch University? It's so good to have you here because today's topic is one of the most important concepts we need to cover. Over the years, we have covered topics like money, mindset, investing, behavioral finance, and mastering the game of smart investing. But today we're going to talk about one of the most heartbreaking things investors do, which is effing up a good thing. Hence the title, Don't F This Up. Let's set the stage. You've done the research, you correctly assessed how the market was going to move, you got in early, and now your investment is growing and booming. Awesome, right? Well, here's the deal. Sometimes the biggest mistake isn't a bad investment, it's mishandling a good one. It doesn't matter if we're talking about precious metals, stocks, real estate, or even cryptos. Once you're in the game, staying in it successfully takes discipline and strategy. We've all heard the phrase snatching victory from the jaws of defeat, as few things are as exciting as winning when it seems like a loss was certain. Well, if that feeling is as high as good feelings can get, then the opposite feeling has to be pretty low. I'm talking about when you snatch defeat from the jaws of victory. How many of you remember the Music City Miracle? It was January 8, 2000, AFC wildcard game between the Buffalo Bills and the Tennessee Titans. The Bills had just kicked a field goal, were leading 16-15 with 16 seconds left in the game, and all they had to do was kick the ball off and let the clock run out. Or maybe you remember Game 6 of the 2013 NBA Finals between the Miami Heat and the San Antonio Spurs. The Spurs led the series 3-2, and with 30 seconds left, they were leading by 5 points, only to have Ray Allen hit a three-pointer with 5.2 seconds left, which then propelled the Heat to win Game 6 and ultimately the championship. In both of these examples, the assignment was really simple for the Bills and for the Spurs. Don't F it up. Far too often, average investors do something very similar. Usually because of poor decision making, they snatch defeat from the jaws of victory and turn likely success into failure. Today, we're going to dive into the 5 most common ways investors F things up and how you can actually avoid those traps. Well, all 5 of these points are very important. The first point is the most foundational and the one you have to master because all the other ones build on each other, actually. The first is don't be a bull and don't be a bear, be an optimist. The tendency is to look at markets, be it stocks, real estate, or whatever, as either being bullish or bearish and having the same kind of mentality. When in reality, markets are made up of lots of ups and down gyrations. It's not as simple as an either or situation. For example, when it comes to silver, how many times have you heard me say, I'm long-term bullish but short-term bearish? The only time you should view markets as either bullish or bearish is when you're looking at them over long periods of time and trying to determine general trends. Once you realize that you're in a bull market trend, your mentality has to shift to being an optimist. Being an optimist is important because it shapes how you approach risk, market volatility, and even long-term opportunities. This is critical because it allows you to see the price swings not as being risky, but as regular price volatility, so that you don't panic buy or panic sell. It also allows you to be confident enough to take calculated risks, like building positions long before you receive price confirmation like most investors wait for. This step alone is how you make the easy money, as Rick Rule says. Being an optimist allows you to focus on opportunities, be disciplined to hold your position, and patient to ride out the waves and the ups and downs of the market. While optimism isn't enough by itself, it does help you develop the right mindset to navigate challenges and capitalize on future gains. I started with being an optimist because the second way investors F things up is really 2 sides of the same coin, which is selling too early and waiting too long to sell. So let's call number 2 pigs versus hogs. Say what? Yeah, pigs versus hogs. As the saying goes, pigs get fat, hogs get slaughtered. It's almost impossible for us to buy at the bottom and sell at the absolute top. So when you think you're buying at the bottom, you have to lean into your optimism. For example, when you buy and then the price goes down another 30 or 50%, your optimism will help you see that as a buying opportunity. See it as the item going on sale. It's at these bottoms where you want to get fat like a pig and eat as much as you can. In contrast, you have to take profits along the way because nothing goes up forever. The challenge as an investor is determining when and how much when it comes to taking profits. Frankly, that is going to depend on the individual. Some people like trimming along the way, some like getting their original investment money back as soon as possible, and others try to squeeze every penny out of the profit that they can get out of something. Often, it becomes a battle between fear and greed, which is dicey. Instead, let's use point number 3 to help guide us. The third thing you can't do or you risk effing things up was best said by Charlie Munger when he said, "The first rule of compounding, never interrupt it unnecessarily." As I just said, at market bottoms, you definitely want to be a pig and get as fat as possible. And conversely, we don't want to be a hog at the tops or we will get slaughtered. Charlie Munger is warning us not to interrupt our making money along the way. This was just my personal opinion, but the number one reason why people screw this up is because they don't know or understand the market that they're in, especially as it relates to evaluations. Most people use price incorrectly. They buy something, and if the price remains the same or goes down, they see it as a bad investment. While when the price goes higher and higher, they seem to feel smarter and never want to let go. Your understanding of the market cycles, technical analysis, and company evaluations will help you determine when something is overbought and time to get out. This bull market, I'm going to do everything in my power to avoid taking profits early so that I don't unnecessarily interrupt compounding. And when the data indicates that the market is getting too frothy or ready to change, or that I'm starting to feel a little bit like a hog, I'm going to put myself on a diet, aka take some profits off the table as protection. It's much better to be a little early compared to a little late when it gets to selling. The fourth thing you can't do is actually happening right now while you're watching this video, and that's not pushing at the right time. In hindsight, we now know the last year and a half, we were buying metals at the market bottom. As I said, you want to be a pig at the bottom of the market and get as much as you can. Well, the same mentality applies when the market starts to break out like it is right now. While I try to avoid the back up the truck mentality, if you aren't pushing hard right now, what in the hell are you doing? This is literally the setup of a lifetime, and it can't be unclear what's going to happen next with precious metals. Many of us have been sitting and waiting on this precious metal train, waiting for it to leave the station. The train is starting to leave the station, and the last thing you want to do is be running down the platform, chasing it down and hoping to grab onto something. You don't have time to wait for more confirmation. You need to be pushing while things are still cheap now. Now, go out there and be reckless, but at the same time, you don't want to look back with regret. So how much gold and silver do you need? The best answer I can actually give you is you want to have enough gold and silver that if they hit the crazy numbers that some people talk about, you have enough to significantly improve your life financially. This leads me to the last thing that you can't do in the bull market or risk effing things up, which is not utilizing leveraged vehicles. Now, I know some of you just can't go there with me with mining stocks, but the reality is that mining stocks offer some of the best opportunities, dare I say, in the world. When the price of physical metals increase, mining companies can grow exponentially. While our physical metals could do a 3 or a 4x, some of these mining companies can give you a 10, 20, or even 30x return on your money. Let me be clear. You need to establish a very solid physical metals position first. But after that, you have to give yourself some room to consider miners for some additional leveraged growth that you just can't get from the actual metals themselves. Let me give you some examples of my miners that have returned over 100% thus far. And no, these aren't recommendations, but this is what I want you to see what it can do already, and the market hasn't even really taken off. My Aya Gold is up 154%. My core mining up 118%. Erdene Resource 99.89%. Not quite 100, but you know what I mean. Free Gold Ventures 134%. Hercules Metals 104%. While physical gold and silver have performed well, the leverage growth from these miners is impressive. On top of that, the multiples gained from miners allow you to actually purchase more physical metals with those profits if that's what you want to do. On top of that, some miners pay dividends, which can serve as an income stream. For example, B2 Gold pays a 5 to 6% dividend just for you to hold in the stock, which then allows you to win twice. You can win with price appreciation as well as dividend income. If you're willing to do the work and research these companies and willing to take on the risk, mining stocks offer incredible optionality to your investment returns. There you have it, folks. The 5 things you can't do this bull market or risk effing up this opportunity. In the comment section, which of the 5 things listed did you find most interesting? What else do we need to avoid during this bull market? Or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.